And given these markets, Ken, I mean, what do your clients say? You know, they watch CNBC. We're down 600 at 11 a.m. They call you at 3 p.m. We're flat. What do you tell them?
You have to ignore the noise, because that's really what we're having right now. I mean, obviously, bigger numbers mean bigger swings. 1% and 2% now mean hundreds and hundreds of points. But, you know, it's been talked about, all the algorithms, the computers firing off trades. But the bigger point is people really have to know what their portfolios are about. Otherwise, they're not going to sleep at night, because they have to understand that this volatility is more the normal part of historic markets, not what we've seen over the last few years.
Well, I think we got you. I get your point, Kim, and we'll get to more on that in a second. But I want to go back to the sort of the swings, because yes, we know math, right? The numbers get bigger because the percentages stay the same when it's 25,000 on the Dow. We get that. However, down 600 and then coming back 600, down 700 last week, back 700. You've been doing this a long time. Is that the sign of a healthy market?
Well, I'll tell you what, it's a sign of a very changed market. There's estimates I've read that it's only about 40% of the market now that are actually stock pickers, people that are doing homework and trying to do fundamental analysis. 60% of the market volatility, or trading, excuse me, is coming from automated programs and professional traders just trying to gain the day's momentum. So it is not your grandfather's market. It's not really the way to run a market that we grew up with, but unfortunately it's the market we have, and with more and more technology coming in, it's likely to be the one that we're going to continue to have to live with.
You ever been to an amusement park?
I sure have.
You have, right? There are people who like the merry-go-round.
Yeah.
And then there's people who love these extreme roller coasters. The people who like the merry-go-round tend to not ride the roller coaster. The stock market has become that way. How do we convince them that they've got to just ride these swings out? That ultimately it's a good thing to be invested in stocks, but you're going to have to deal with these loops.
Well, let me offer a little bit different analogy. Picture you going down the highway in the right lane doing your 60 miles an hour, and in the left lane, you have these Ferrari race cars going back and forth, back and forth. You have to stay in your lane and not let that distract you, because your goal is to make $1 million over a lifetime. Their goal is to try to make $1 million by 3 o'clock today.
Okay.
So don't let them scare you or get you off the track.
So the right lane people, by the way, I like to flash my lights at them. That said, you advise your clients to keep, or you do it for them, 6 months in cash?
Yeah, I think one of the ways to really not only sleep at night, but to run your portfolio in your personal life is to keep at least, you know, a 6-month reserve in cash, and sometimes a year in cash if you're expecting a big outlay in the coming year, because you don't want to have to be selling stocks into a manic movement in the market down, because once you lock in that loss, it's not coming back. So I think a good part of good cash management and good kind of future planning is to keep cash available, and don't worry that that's not getting a return if it's what you're going to need to spend.
Okay, yeah, and I know we got to go. You recently wrote you got to buy when everyone's crying or something. You're buying when they're crying?
When I started in the business, a guy told me something great. He said, if you want to be successful, the two things you got to learn, you got to buy them when they're crying and sell them when they're yelling.
Okay, so we're crying a little bit now. Not a lot. We're still, you know, flat on the year. We're crying a little bit. What looks good? Give us some ideas before you go.
Well, I still like the broadening out the portfolio to more value names. I still like the idea of, you know, some of the infrastructure, the industrials, materials, probably, you know, the pharma, but kind of like the non-high-techy pharma. You know, I think that we're in the zone now where you have to broaden out your portfolio, because if you've just been relying on momentum to carry the day for you, because you didn't know what was in your portfolio, and you didn't understand why your stocks were up, but you were thrilled every day that they were up, that same ignorance that allowed you to be thrilled, you have to keep that ignorance in your mind to not get you freaked out in markets like this.
Yeah.
Profits are made from down markets, not up markets.
Well said.